What if I told you that the stock price you see on your screen every day is one of the least important things about investing? Warren Buffett, one of the greatest investors of all time, famously said, "Price is what you pay, value is what you get." Yet most investors do the opposite. They obsess over price movements and predictions instead of understanding what a business is actually worth. In this video, I'm going to explain how Warren Buffett thinks about the intrinsic value of a stock, why it matters more than price, how to actually calculate it, and how this simple idea has helped him build one of the largest fortunes in history. Welcome to Martic Finance, where we explain investing concepts in a simple way. But first of all, a quick disclaimer. This is not financial advice. Warren Buffett is the chairman and CEO of Berkshire Hathaway, a company he turned into a massive investment empire. For over 6 decades, Buffett has consistently beaten the market, not by trading or guessing, but by valuing businesses. One of Buffett's most important beliefs is this: if you wouldn't buy the entire business, you shouldn't buy the stock. When you buy a stock, you're buying a piece of a real company, with employees, customers, products, and cash flow. But the stock market often behaves like a casino. Buffett uses a famous analogy called Mr. Market by Benjamin Graham. Mr. Market shows up every day offering to buy or sell businesses at emotional prices, sometimes optimistic, sometimes depressed. Buffett doesn't let Mr. Market tell him what a business is worth. Instead, his entire philosophy is based on one powerful idea: the intrinsic value. In Buffett's own words, intrinsic value is the present value of the cash that can be taken out of a business during its remaining life. In simpler terms, intrinsic value is what a business is truly worth based on how much cash it will generate in the future. Buffett also emphasizes that intrinsic value is not a precise number. It's an estimate, a range based on assumptions about the future. He also defines intrinsic value like this: well, intrinsic value is the number that if you were all-knowing about the future and could predict all the cash that a business would give you between now and Judgment Day, discounted at the proper discount rate. That sentence contains 3 key ideas. First, all future cash the business will produce. Second, when that cash will arrive. Finally, discounting that cash back to today. Buffett often compares stocks to bonds to make this clear. When you buy a bond, the cash flows are printed right on it. You know how much you'll receive. You know when you'll receive it. You know when you get your principal back. With a stock, none of that is printed. Buffett says, the cash flows aren't printed on a stock certificate. That's the job of the analyst, is to print out, change that stock certificate, which represents an interest in the business, and change that into a bond. That process is called discounted cash flow analysis, or DCF. Let's walk through a complete example using a fictional business. We'll call it Harbor Tools. This is not a tech startup. It's a boring, stable, predictable business, exactly the kind Buffett likes. Step 1. Find the cash the business produces for owners. Buffett cares about cash, not accounting profits. Specifically, he cares about owner earnings, the cash that can be taken out of the business without hurting its competitive position. First, Warren Buffett originally defined owner earnings as the result of the net income plus non-cash charges minus maintenance capital expenditures. The main problem with using the original owner earnings formula is capital expenditures. In financial reports, companies usually disclose total capital expenditures, but they do not clearly separate how much of that spending is required just to maintain the business versus how much is spent to grow or expand it. For valuation purposes, we only want maintenance capital expenditures because growth spending is discretionary and depends on management's decisions. But since maintenance capex is rarely reported, we're forced to make estimates, and those estimates can easily be wrong. To avoid this problem, we use a practical and conservative approximation. Instead of trying to split capital expenditures, we assume that all capital expenditures are maintenance, even though that's not perfectly accurate. This leads us to a simpler and more conservative formula. Free cash flow is equal to operating cash flow minus total capital expenditure. By subtracting total capital expenditures, we may understate the cash truly available to owners. but we reduce the risk of overstating intrinsic value. Let's assume Harbor Tools produces $120 million per year in free cash flow. Step 2. Estimate future growth, conservatively. Now we ask, how will this cash change over time? Buffett is extremely conservative here. He avoids optimistic assumptions. Let's assume the business is mature. It grows slowly with the economy 4% annual growth. Step 3. Project the future cash flows. For our example, we are going to project this for 10 years. Now we have an estimate of how much cash the business will generate each year. Step 4. Choose the discount rate. Now comes a crucial Buffett question. What return do I require to justify laying out money today? Buffett has said he often uses long-term interest rates or a reasonable equity return. Let's assume Buffett wants a 10% annual return. Step 5. Discount each cash flow to present value. Now we discount each year's cash flow back to today. Why? Because $1 received in the future is worth less than $1 today. Even though Harbor Tools' cash flows are growing, their present value declines the further out in time they are. Step 6. Calculate the terminal value. Businesses don't disappear after 10 years, so Buffett asks, what will this business continue to earn beyond year 10? The terminal value represents the value of all cash the business will generate after that year. For our example, the free cash flow in year 10 is projected to be almost $171 million, assuming modest growth of 4% per year over the forecast period. We assume that beyond year 10, the business will continue to grow at a small, steady rate of 2% per year. To calculate the terminal value at the end of year 10, we grow year 10 free cash flow by the terminal growth rate and divide it by the difference between the discount rate and the terminal growth rate. That gives us the terminal value of approximately $2.18 billion. But we need to bring that number back to today, because money in the future is worth less than money today. We discount the terminal value using the same 10% discount rate over 10 years. Doing that, the present value of the terminal value comes out to about $924 million. Step 7. Add everything together. Now we add the present value of 10 years cash flows, plus the present value of the terminal value, giving us a total intrinsic value for Harbor Tools of about $1.75 billion. Finally, we compare intrinsic value to the current market capitalization. If Harbor Tools is trading at $2 billion, it's overvalued. $1.75 billion, it's fairly valued. $1.1 billion, now we may be interested. This comparison is the entire point of valuation. Buffett never buys at intrinsic value. He insists on a margin of safety, because when we try to predict the future, there is always uncertainty. Our estimates can never be perfect, and real life rarely unfolds exactly as we expect. Buffett might require a 30 to 40% discount. This margin protects him if he's wrong, and boosts returns if he's right. Nowadays, finding a stock trading below its intrinsic value isn't easy. Most companies today are priced based on market sentiment, growth expectations, and investor enthusiasm rather than their real value. That means undervalued opportunities are rare, and it takes patience, careful research, and discipline to identify them. If you enjoyed this video, make sure to like, subscribe, and comment below what video you want to see next on the channel. Thanks for watching, and I'll see you in the next one. Bye.